Western Midstream Partners just beat consensus estimates on both the top and bottom lines for Q2 2026.
Yeah, they really did. I mean, we're talking $1.22 billion in reported revenue.
Right, which is an 8.34% surprise over that $1.13 billion estimate. And that's a 30% increase year over year.
Huge jump. And the EPS came in at 99 cents per share, so that beats the 90-cent estimate by 10%.
Up from 87 cents a year ago. But,
Yeah.
the real kicker was the guidance. Management issued these massive upward revisions for full year 2026.
Yeah, they raised the adjusted EBITDA midpoint by a full $250 million.
Which is a 10% bump, right, up to $2.85 billion.
Exactly. And the free cash flow midpoint got raised by 20% to $1.2 billion.
And the stock reacted, well, constructively. It gained 1.76% in the session following the report.
Closing at $46.26, so it's sitting very close to its 52-week high range of 47.0 to 48.1 cents.
Okay, so the headline beats and those guidance raises are out there, but for any retail investor, the immediate next step is looking under the hood, right?
Right, you have to look at the operational throughput.
Yeah, to understand exactly how they achieved those beats. And it looks like they hit some serious throughput records.
They did. Natural gas throughput hit 5.3 billion cubic feet per day.
Which is a 3% sequential increase.
Yep. And produced water throughput reached 2,939,000 barrels per day, so a 5% bump there.
And crude oil and NGLs saw a slight sequential bump too, right?
Yeah.
Up to 523,000 barrels per day.
Right. But to really get this, we need to break down that $250 million bump to the full-year adjusted EBITDA guidance. It's an EBITDA bridge.
Right. Let's unpack that. Where's the money coming from?
So it breaks down cleanly. First, $100 million of that comes from the recent Brazos Delaware 2 acquisition.
Okay, $100 million bought.
Yeah. Then $80 million comes from elevated commodity prices, assuming second-half crude averages $71 a barrel.
Got it.
And the last $70 million is from portfolio-wide throughput outperformance and what they call plant recovery efficiencies.
Okay, wait, I got to push back here a little bit because I look at the $100 million from the Brazos Delaware 2 acquisition as just like a plug-and-play engine swap.
Yeah, you buy it, you bolt it on.
Exactly. It instantly boosts horsepower for Q2. And then the $80 million from commodity prices, I mean, that's just macro luck.
It's the market, yeah.
So if you strip out the $100 million you got and the $80 million gifted by luck, is that underlying $70 million operational beat actually enough to justify the stock hovering near 52-week highs?
Well, I mean, you have to look at the Brazos integration a bit differently. It's strategically expanding their Delaware Basin footprint.
But it's not organic growth.
It's not. But those plant recovery efficiencies, that shows management is actually squeezing more margin out of the existing assets. They aren't just buying growth.
Okay, fair. How exactly are they squeezing that margin? What's the physical efficiency there?
So think of a processing plant. If prices for heavier liquids like ethane or propane are high, an operator can physically tweak the plant's temperature and pressure.
Oh, like chilling the gas more aggressively to wring out the expensive stuff.
Exactly. You recover more of those high-margin liquids from the raw gas stream. It's smart optimization.
Interesting. And looking ahead, they executed 2 new gathering and processing agreements in the Powder River Basin, right?
Yeah, securing 270,000 dedicated acres.
With minimum volume commitments.
Right, MVCs. That's huge for supporting their 2027 natural gas growth.
Okay, so high throughput is great, paper earnings are great, but in the midstream sector, none of this matters if it doesn't translate to cash.
Right, cash is king in midstream.
So let's shift to the cash generation and capital allocation, because this is where the story gets, well, a little complicated.
It does. They had record cash metrics. Adjusted EBITDA hit a record $736.5 million.
Wow.
Distributable cash flow, or DCF, came in at $537.2 million. And free cash flow was $263.6 million before distributions.
Okay, let's talk about the distribution. Maintained at 93 cents per unit for the quarter.
Right, which is a $3.72 annualized run rate.
But here's the catch. Free cash flow after those distributions was actually negative $111 million.
Yes, negative $111 million.
Which is completely driven by heavy organic growth capital expenditures.
Absolutely. They reaffirmed CapEx guidance at $850 million to $1 billion for the year.
And management expects to hit the high end of that range, right?
Yeah, they have to fund projects like the Pathfinder pipeline and the North Loving-Tufukin plant.
Which doesn't even come online until 2027.
Exactly.
And to fund this gap, WES is relying on external markets. They just issued $700 million in senior notes due in 2036.
Mostly to refinance Brazos related borrowings.
Okay, I have to use a personal finance analogy here.
Yeah.
Because to me, this looks like a homeowner who just got a massive raise at work, the revenue beat,
Right.
but they're still putting a highly expensive new roof on a credit card. I mean, negative free cash flow after distributions, plus a $700 million debt issuance. Is this capital intensity sustainable?
Well, you have to remember the classic midstream business model. It's not a roof on a credit card.
What is it then?
It's heavy upfront capital expenditure to build essentially a toll road. That negative post-distribution cash flow isn't necessarily a red flag if the capital is efficiently allocated to projects like Pathfinder.
Because those guarantee long-term capacity expansion.
Exactly. You secure future toll road-like cash flows. You have to build the whole road before you can collect the first toll.
Right, but that heavy capital spending leads us right into the risks. Management flags some serious macroeconomic and operational risks on the call.
Yeah, which definitely threaten to squeeze those newly raised margins.
Let's start with rising costs. Operations and maintenance O&M expenses rose 8% sequentially.
And they're projected to increase further in Q3.
That's a direct hit. But the pricing pressures are what really caught my eye. Some customers in the Delaware Basin actively curtailed production during the quarter.
Right, because of negative Waha pricing.
Okay, hold on, explain that. How can pricing be negative?
So Waha is a major hub in the Permian. When there's not enough pipeline capacity to take the gas out of the basin, it gets trapped.
Too much supply and nowhere to go.
Exactly. So the local price actually drops below zero.
Wait, really? Like, I could drive down there with a tank and they would pay me to take the gas away.
I mean, if you had a big enough tank, yeah, theoretically.
That's insane. Why even pump it out of the ground?
Because they're drilling for oil, not gas. The gas is just a byproduct. But if they can't sell it and they aren't allowed to just burn it off, they have to shut the whole well in.
Meaning they stop pumping the oil too.
Exactly. And when they curtail production, Western Midstream loses that volume.
Which explains the throughput headwinds. I mean, despite the slight Q2 bump, full-year crude oil and NGL throughput is expected to decline.
Yep, full year's looking down.
Plus, the full benefits of the Brazos integration won't even be realized until year-end.
True.
So isn't there a huge contradiction in the guidance here? Management is relying on an assumed $77 average full-year crude price to hit their EBITDA target.
And $71 for the second half?
Right, but simultaneously they're facing customer curtailments because of negative gas pricing. Doesn't this make the raised guidance dangerously fragile to commodity volatility?
It's definitely a balancing act. Midstream operators have fixed fee contracts, right?
Yeah, they get paid for the volume regardless of price.
But if negative Waha pricing hurts volume at the margins because producers shut in, those fees disappear.
Exactly my point.
But this is where that Powder River Basin deal comes in.
Oh, the 270,000 newly dedicated acres.
Right. The sheer scale of that agreement provides a long-term buffer against localized pricing anomalies like Waha.
So they're geographically diversified.
Exactly.
Wow, okay. So leave the listener with a critical valuation debate to mull over. At around $47 a share, some models view WES as roughly 4% overvalued right now.
Which means it's pricing in a perfection scenario.
Yeah, assuming Pathfinder and North Loving II go off without a hitch.
Right, but if commodity prices slip or O&M expenses keep climbing that 8% sequentially.
Will the heavy capital intensity of 2026 become an anchor on 2027's promised cash flows? That's the question you have to ask yourself.
Definitely something to watch closely.
Follow the show for daily earnings coverage.